Hello students, for this video clip, we'll practice how to calculate the value measurement, the market capitalization, which is total market value of equity, and the market value added, MVA, the market value exceeding the book value of equity, and then also the market to book ratio. We also want to calculate performance measurement, which is the economic value added, EVA, and residual income when the company has 100% equity financing. We have the actual the financial information of the Home Depot in 2014 with 2013 data. This income statement shows 2014 income statement. Current asset and fixed asset, total asset, 2 years ending the balance, and the liability and equity. We also have this additional information of Home Depot, the financial information, the price per share as of December 31st, 2014. And number of shares outstanding is 1.307 million shares. And then weighted average cost of capital is 9%, cost of equity is 12%, tax rate 35%. Okay, then let's start. Let's get started from the value measurement. As of now, December 31st, at the moment of December 31st. So we are not using 2013 data, but 2014, December 31st, at the moment of December 31st. Market capitalization, how to calculate it? Market capitalization is calculated number of shares outstanding times stock price per share. At the moment, we want to calculate. So price per share times number of outstanding. So 149,978,000,000 dollars is market capitalization as of now, December 31st, 2014. And the market value added. Market value added means the market value, how much a market value exceeded the book value of equity. So we want to compare the book value of equity. Here you go. The book value of equity. The book value of equity is now 9,322. We want to compare this book value of equity with the market value capitalization. So how do you get it? We want to subtract this, subtract the 9,322 from 149,978, the market capitalization, minus 9,322, the total shares equity in 2014. So as you can see that the market value added is huge amount, $140 billion. Okay. Then the market to book ratio shows kind of multiples calculated by the market value of equity divided by book value of equity. Because we want to know the not just the magnitude of the market value added, but also how much times it has been increased from the book value. So we can get this sense of the multiples. So how do you get it? The same way from the book value of equity, 9,322. So 16 times has been increased from the book value of equity, the market capitalization, okay, in 2014. Now, let's measure the performance of the company. Now, the performance measurements for the period of the year 2014, we need to consider the concept of the performance. Performance has been generated throughout the year, not just the point of a time. but we measure this performance at a point of time 2014 at the end of a year, but the performance has been made throughout the year starting of 2014 or the end of year 2013. So we need to consider these 2 years information and income statement. Okay. How do you get the economic value added? Economic value added is considering income for all investors. Income for all investors means interest after tax for the debt holders and the equity shareholders benefit. That is all the income for all investors. And minus a charge for the cost of capital. The all income for all investors is calculated net operating profit after tax. Net operating profit after tax means interest expense times 1 minus tax rate, which is the debt holders benefit, and the net income is the equity holders benefit. That is considering all the income for all investors considered. And then operating cost of capital times total capital employed, which is long-term debt, and the equity means now a charge for the cost of capital. If a company generates economic value, that means that income for all investors now exceeded the charge for the cost of capital, right? That shows the performance of the value. So let's calculate economic value added. Income for all investors. Now we want to take a look at the income statement is interest expense 830. Do you see the 830? So 830 is the starting point times 1 minus after tax, because interest is tax, the cash outflow, the cash generation, which should be the the considered with tax, and then tax rate is 35%. And then we should add, right, the net income 6,345. That is all the incomes for all investors. Now let's subtract a charge for cost of capital. A charge for the cost of capital. How do you calculate it? The WACC times weighted average cost of capital considered all the debt and equity. So WACC is now 9%. Then times, we want to combine the two amount of debt. Which one? 2014 long-term debt or 2013 long-term debt? Okay, definitely 2013 long-term debt. Why? As we discussed it in class, throughout the year to generate this the net income, all the sales or some expenses, the company uses long-term debt at the end of year 13 throughout the year. 2014 is considered a new debt during the year 2014. It's not been used full amount, but this 14,691 is the long-term debt amount that has been employed to generate this benefit of the year. So we use this 14,691, right? And the net income, the book value, now the equity amount. What equity amount do you want to apply here? 9,322 or 12,522 in 2013. Definitely 2013 as the same reason. So 12,522 here for the equity. So now we calculated this cost charge, and then we got the economic value added, EVA, 4,435. Residual income considered only equity capital. What is the economic value added considered only the equity capital? Now we use net income here, 6,345, and minus, now which cost of capital we use? Weighted average? No, cost of equity, because weighted average cost of capital considered a portion of the debt, but we consider only the equity part, is cost of equity, so 12%. 12% times, as we applied earlier, the shareholders' equity in 2013. So 12,522. So residual income for the equity financing is, the residual income is 4,842. Next, how to calculate return on capital? Return on capital is calculated net operating profit after tax. We are not using net income only. Why? Because we are using total capital, which is the long-term debt and the equity. So we need to consider interest expense after tax as well for the debt holders' benefit. So return on capital is calculated how? Okay, the same way. 830. Okay, what happened? 830, which is interest expense. Now times 1 minus tax rate, 35% tax rate. Then plus 6,345 net income. Then I want to just close, make the parentheses for the numerator, and then divided by, now total capital used for the debt, long-term debt, and long-term debt was 14,691, and then equity was 12,522. 2000, these two numbers, long-term debt 14,691 and 12,522. So we got 25.3% is the return on capital. This return on capital is way higher than the cost of equity or weighted average cost of capital. That's why the Home Depot made the economic value added a lot. Next, the return on asset. Return on asset also can calculate it in the same way. Net operating profit after tax divided by total asset. So I just want to use the same equation, except for this. Okay, instead of this denominator, I want to use total asset. How much is the total asset? Total asset, also we use 2013 information. Total asset 40,518. So 40,518. So we got the total return on asset is 17.71%. That means that, okay, what is that? Oh, sorry, it should be 31. Okay, the tax rate. So 16.99%. That means that $1 of asset generated, $1 of asset generate 16.99 cents of the net operating profit after tax, considering the interest and net income. Finally, return on equity. Return on equity is calculated by, now, net income divided by equity. how much was the net income? Net income was 6,345. 6,345 divided by the equity. Equity, we are using this 2014 13 information as well, because in order to generate this net income 345 net income throughout the year, the company used this equity 2013 at the end of the year, so 12,522. So 50%, 67%, which is way higher than any other performance. That means that $1 of the equity generate 50 cents of return for the equity holders. That shows huge performance, the profitability. Okay, so I believe those the performance measures and the value measures is very advanced measurement, beyond just the simple ratios that we have learned in the financial accounting and any other classes. So please remember this: the value measurement of the market capitalization and market value added, market to value market to book multiple ratios, and the EVA, residual income, ROC, ROA, and ROE, using the NOPAT, the net operating profit after tax concept. Okay, see you in the next video clip. Bye bye.